Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top business stories. A second rate hike in 5 weeks. The Monetary Policy Committee increases repo rate by 50 basis points. That's in line with expectations. The MPC also voted unanimously to focus on withdrawal of accommodation to tame rising inflation. RBI expects CPI to remain well above 6% target until at least the end of the year, raises its FY23 inflation forecast by 100 basis points, projects inflation at 6.7% for the full year. RBI retains GDP growth forecast at 7.2%. RBI allows linking credit cards with UPI platform. RuPay credit card will get the facility first. Also expands e-mandate limit for recurring payments via credit and debit cards to 15,000 rupees. Market extends losing run to fourth straight day as the RBI hints at more rate hikes to tackle inflation. Sensex ends 215 points lower, Nifty below 16,400. The rupee ends at a record closing low against the US dollar. Government hikes minimum support price for 17 kharif crops. This move will provide assured remunerative prices to the farmers. The cabinet hikes paddy MSP by 100 rupees to 2,040 rupees per quintal for the 2022-23 crop year.
The MPC voted unanimously to increase the policy repo rate by 50 basis points. In extremely volatile and uncertain conditions, we just cannot give any forward guidance. The real GDP growth for 2022-23, that is for the current year, is retained at 7.2%.
The Reserve Bank of India has zeroed in on inflation as its enemy number one, jacking up the benchmark repo rate by half a percentage point to 4.9%. This is the second increase in less than 5 weeks and will translate to your loan EMIs increasing again in probably the next fortnight.
The war in Europe is lingering and we are facing newer challenges each passing day, which is accentuating the existing supply chain disruptions. As a result, food, energy and commodity prices remain elevated.
The agenda was clear in the first 30 seconds of the RBI Governor's policy statement. Inflation is the millstone weighing the heaviest around the central bank's neck. To control the spiraling prices, the Monetary Policy Committee of RBI unanimously decided to hike repo rates by 50 basis points to 4.90%, making the money more expensive for those looking to borrow, effectively reducing the supply of cheap money in the market. However, RBI has been forced to concede that the present inflation is more determined. The central bank has raised its inflation estimate for 2022 to 2023 to 6.7% from the earlier 5.7%, saying that 3/4 of the increase was attributed to rise in food prices. He also warned that inflation will remain above RBI's upper target of 6% for at least the first 3 quarters of this financial year. The rate is expected to moderate to 5.8% in January to March 2023.
Inflationary pressures have become broad-based and remain largely driven by adverse supply shocks. There are growing signs of a higher pass-through of input costs to selling prices. The MPC noted that inflation is likely to remain above the upper tolerance band of 6% through the first 3 quarters of the current financial year, that is 22-23.
The RBI governor also warned of global challenges to the Indian economy, listing out negative spills from geopolitical tensions, elevated international commodity prices, rising input costs, tightening of global financial conditions, and a general slowdown in the world economy as big retardants. Shaktikanta, however, remains confident of the Indian business panorama.
Our surveys suggest further improvement in consumer confidence and households' optimism for the outlook a year ahead. Business sentiment remains upbeat according to early results of our surveys.
The RBI has kept the GDP growth estimate for the current financial year unchanged at 7.2%. This growth rate forecast is, however, expected to fall each subsequent quarter, a clear indication that the economy is not anywhere out of the woods yet. Bureau Report, Business Today Television.
Our managing editor Siddharth Zarabi joining us now for his take on the RBI's announcements today, rolling back their accommodative stance. Siddharth, very significant from both a market and economy perspective.
Well, you know, the best way that I can at least describe what the RBI has done today is to tell all of India that inflation will remain elevated beyond its 6% upper end target for the next 6 months. And afterwards, in January, February, March, there is a likelihood that it will slip below that, but just by about 30 basis points. So effectively, the rest of the current financial year is a year where the RBI will roll back, as you put it, and reach a pre-COVID interest rate environment. However, since growth is a concern, and the bank's ability to lend and keep that side of the economy going, the RBI has made appropriate adjustments and accommodations, if I may put it that way. The second major thing is the RBI has also told all of us that the inflation build-up, 3/4 of that is happening on account of food prices. Now, food prices are extremely politically sensitive in India, and as the rest of the world, the Western world is also learning, they are sensitive, and that puts some amount of pressure on the government of India. And I would end by saying, Abha, that the RBI governor's clear-cut statement, in as direct as a RBI governor can speak, about the states' need to cut the taxes that they levy on petrol and diesel, is a headline statement, because if the states were to do that, that will immediately lead into a decrease in the headline number. Because remember, the RBI has now shifted, after some amount of criticism, from being completely accommodative for growth to becoming an inflation warrior. But today the governor has, in a way, prepared all of us that there are limitations to even the RBI's ability and the effectiveness of interest rate hikes in controlling inflation, which is largely driven by food. So interesting 6, 8, 9 months that are going to play out. Be prepared for extension of EMI tenures, like you said, and money is not going to get cheaper anytime soon. And in fact, for an even better take, we are joined now by no one else but the chairman of India's largest bank, Dinesh Kumar Khara, the chairman of the State Bank of India. Mr. Khara, thank you very much for joining us here on Business Today. The question that everyone wants to know is, the RBI has now, for the second time in a short period of time, hiked the repo rate, and it will get passed on in some format. Your thoughts on what you will do as a bank, and whether it will be effective in controlling the inflation monster that we seem to be grappling with.
Yeah, I think if we really look at it, the inflation risk which were flagged in April and May resolutions of the MPC, they have actually now materialized if we look at the inflation numbers. So which means that this is something, inflation, of course, we keep on saying that it has become a global phenomena. So, and since the economy is coupled with the globe, so naturally it gets imported into the economy. So, and I think in such a situation when RBI is supposed to really ensure that the growth is maintained in the economy, and at the same time the orderliness remains in the economy, perhaps this was warranted. And also it may not be out of place to mention that inflation trajectory across the globe is still not really receding. This is something essentially attributed to geopolitical tensions. So naturally in such a situation there is a need for a calibrated monetary policy action, and in that context I would say that inflation expectation has more or less got anchored, and there is adequate restraint as far as the pressures on the prices are concerned. So I think that that's the context in which this kind of a policy has been announced by RBI.
Before I go across to my colleague Abha, a quick follow-up, sir. What does this mean for State Bank of India customers? And you have such a large customer base. Are you going to hike the lending rate and perhaps the savings rate as well?